Welcome back to Corporate Radar. For now, we have a quick update on what's happening in the world of commodities. Manisha Gupta is joining in for that. Manisha, hi, morning.
Morning, Sonia. I'm looking at the crude oil prices, and what a sharp decline is what we're looking at into this one. We're trading at a 3-month lows. Overnight has been a 4% decline, and with that, for the week as well, we are down by 4%. Last week was a 6% decline, and for the month of October, it was a 10% decline. So it has been a one-way move for the crude oil prices, and that clearly has been on the weaker side there. Well, we have seen a steep rise in the U.S. inventories, and that really seems to be weighing on. The U.S. consumption also seems to be slipping down, and that's what's bothering the markets. If you look at the inventories itself, the expectation is that you could have seen 12 million barrels of a rise come in for this one. The U.S. consumption is down by nearly 300,000 barrels versus a rise estimate of around 100,000 barrels. This is the latest report from EIA also telling you. And then you have weak China data, the trade numbers that came in yesterday, and with the export numbers coming in way below what the street was anticipating, has been weighing on. Now the street will watch out for the Chinese inflation data that comes in on Thursday then. And then Israel is also considering tactical pauses when it comes to its conflict with Gaza. There also is no other Middle East country joining in. There is no impact whatsoever on crude production or export from that area, and that has taken the whole of the war premium off the prices as well. And the markets also are looking at the Saudi Arabia and Russia output cuts, where they have reiterated that it will continue until end of December. But with the demand as well declining from China, from Europe, from US as well, this clearly hasn't had much of an impact into the markets. I will want to take you to a volatility picture that we've seen in this year when it comes to the crude oil prices. We started with $82 a barrel and then saw a sharp decline up to $70 a barrel in the month of June. That is because the first 2 quarters of this year did not see any demand change from China. The economic data continued to be on the weaker side, and that took the prices to a nearly 10-month lows there. And then came the month of September, where we saw OPEC and allies continue to cut production with an expectation that you could be looking at a big deficit in this quarter and the next as well. And that led to a huge amount of hedge fund buying that took the prices to $96 a barrel. And then we saw prices see some profit taking by the month of October. And then came the Gaza and Hamas conflict, which again took the prices back above $90 a barrel. But clearly with that war premium going off right now, we are back at $81 a barrel right now. So it has been a $10 of a decline in last 3 weeks that we've seen come in for the crude oil prices. Another important number to watch out for is the demand expectation for the next year now. So while we've seen a strong demand from a previous year, the next year demand expectation is much on the lower side on an year-on-year basis, much lower when it comes to IEA. OPEC also believes that next year is going to be a strong demand growth, but less than what we saw in this year, and that also seems to be bothering the markets right now.
Okay, thanks a lot, Manisha, for that. Let's slip into